As an active manager, we're finding enormous opportunities in the market today, yet at the same time, we see some pockets of the market with outsized risk as well. And we're going through this period over the last 15 years of a massive divergence between business results and stock prices. And one of the things really behind that is this unprecedented period of free money, of zero interest rates that we're just kind of normalizing and coming out of. 40-year bull market for bonds. We've never seen short-term interest rates this low dating back to 3000 BC. So it's created some crazy anomalies in the market that we think as selective, research-driven active managers, one can really take advantage of. It reminds us very much of the old adage that Ben Graham said and further was made famous by Warren Buffett's letter to shareholders, 1987, and that's that over the short term, the market is very much a voting machine. Over the long term, it's a weighing machine. And we think this year in the market sell-off, which has certainly been painful, is one where those machines are switching from a voting machine to a weighing machine where business results will matter a lot more. So areas of the market we're finding some great opportunities is in select financials, in some e-commerce dominant companies, workhorse technology companies in the semiconductor area where we're seeing enormous growth in the end market, and also in some select healthcare services companies as well as generic pharmaceuticals. In today's market, investors really need to be aware of several things that we think will lead to long-term success. The first is controlling emotion, and that's hard to do in a market that's sold off materially from its highs. And we have a saying here at Davis that volatility minus emotion equals opportunity. And by resisting the natural human tendency to react emotionally to fear in the market, can help make better long-term decisions and not sell at inopportune times. We're seeing a lot of folks wanting to go to cash. We think that's a terrible decision as purchasing power, especially in a higher interest rate environment, will be eroded materially. We've actually seen purchasing power of $1 since 2000 decline 43%, and that was in a very, very low interest rate environment. So eliminating emotion from your decisions, tuning out the clickbait headlines, and sticking to a long-term plan really can help folks. And related to that is don't ignore the power of compounding. Compounding can be material, and you take compounding away when you're selling and getting out of the equity market. Remember, Warren Buffett made over 90% of his wealth after the age of 65, and that was all due to a lot of compounding that went on. There's a reason why Einstein called compounding the eighth wonder of the world. So our message to folks is really take a look deep into what you own, make sure your portfolio emphasizes durability, resiliency, strong balance sheets, and an ability to withstand anything that the market throws to us in any challenges, because market sell-offs are inevitable. They are surmountable though. We know they're painful, but we see a 20% sell-off every 3 years, a 10% sell-off every year, and a 5% sell-off about 3 times a year. So this is not something that is unprecedented. Our awareness of these crises are, and so long as we stay the course and don't let that drive our decisions and make bad decisions on good investments we already have in place, we'll be well served for the future.